Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Coutts multi-asset strategist David Broomfield. Hi David, how are you?
Hi Sarah, I am good. How are you?
I'm not too bad actually. It's good. Weather could be better, but okay. Who knows when you're going to be listening to this? The weather might be great by the time you're actually listening to this.
Who needs the weather when you have news headlines like we've had over the last week and a half?
Exactly. But we're not going to talk about politics. Well, we are sort of, but in an adjacent way. So, David, what are the three things we need to know this week?
Well, we have to talk about the electoral cycle. We just have to. So I think the three things we want to talk about this week, the first one is about elections and how elections impact markets. And how to think about the market cycle in an election year. And I think the second thing, which flows from that, is about this particular economic cycle and what's driving it. And does that change anything?
Yeah.
And then the third thing is about the consumer, because as we'll talk about in this particular economic cycle, the consumer is very important, and consumer confidence and real incomes and all of those things and how they interact with each other.
And interesting, because we've had a couple of sort of conflicting reports coming out just before we recorded this. So it'd be interesting to sort of reflect on those. All right, then let's kick off then. Then we're not going to talk politics because that's not the business of Need to Know, but we are going to talk about what happens to markets. And if this year, we've said this before, this year is one of the biggest years for democracy since, records began. And obviously we've got a couple of big elections coming up. So what happens to markets in these kinds of years?
Yeah, well, it's a huge year, isn't it? I mean, it's 60 national elections, 2 billion people going to the votes. I mean, are we over halfway yet? I think we're 30 South Africa. I think we're 32, maybe 33 elections into our 60 of the year. But all eyes, before this year, all eyes were on the US cycle. And then more recently, obviously, eyes are on the UK cycle. And I think, that the cycle is really important because this is a long process. And take the US cycle as an example, it's about 2 years from initial candidate announcements to inauguration. So surely with a 2-year cycle, how can that come as a surprise to markets? It's possibly the most well signposted. It's the most well signposted event you could ever have, right? The very structure of democratic elections is driven by process and predictability. So, how can there be some kind of shock that there's an election? It shouldn't come as a shock to anyone. And I'm always slightly amused when people run around absolutely like crazy. There's just mountains and mountains of headlines the minute an election's announced, and it's possibly the most predictable event there is.
Yeah, but is the reality then short term? There is a bit of volatility in markets when we know an election's coming, even though we know, and especially as you say in the US, it's highly predictable. We know every 4 years there's going to be an election in November, and the new president will be installed in the following year. Is it January, isn't it? Mid-January. So that's not a surprise. Arguably, you could say the UK election, the timing came as a little bit of a surprise, but we know that one's coming. So surely we get there's possibly some justification for a little bit of sort of market volatility, isn't there?
Well, you would think that's the intuition, isn't it? But again, candidates, particularly in the US case, are very well signposted very early. It's a 2-year cycle. And even in the case of the UK, manifestos are published relatively early, quite late and more recently in recent elections. But, it's generally well understood by industry and business leaders who have bilateral meetings with all of these people, what the policy mix is and what the likely impact is. So, let's look at what history tells you. Since 1966, there's been 15 general elections in this country. Conservative one.
I'll take your word for it, David. You're the historian.
Well, I'm sure we'll get fact checked. I think Conservatives won 9, or at least formed a government, and Labour won 6, or formed a government. And if you go and look at each of those elections, I mean, the overarching conclusion, first of all, is that the market outcome is generally pretty agnostic of whoever wins.
Yeah.
And that volatility is remarkably, well, statistically, not very significant in any one of those election years. Now, there are a couple of nuances to that, because obviously every election is different. Every campaign cycle is different. And you can go back and look at the 2010 election. Why was that different? Well, you remember, if those of you who are listening will remember, it was time for the coalition government. We had a rather protracted period after the election where there was no government. And you can see volatility in the UK markets increasing slightly, but it's nothing what you would call, volatility. It's at the margin, you would say. And similarly, when you look at the actual market outcome of who wins and who is in power, again, there's no real discernible difference in the medium to long-term market outcome of who's in power.
Yeah. I was going to say, I'm looking at Joe Aylett, friend of the podcast, who did some research on this, and I'm looking at the numbers. And there are some years when returns on the index were very good. Some years when it wasn't very good, but that had nothing really to do with the colour of the party in government. It was more to do with probably what was happening in the wider business cycle.
Yeah, that's exactly the point. It's the business cycle that ultimately drives markets in the medium term. Okay, so that's for equities earnings, and then macro factors like rates, corporate profitability, and things like that. I will add a slight sort of nuance to this, which is that, okay, what causes volatility? Generally, uncertainty.
Yeah.
And you can get different kinds of political uncertainty in around elections. During the campaign, you can get unexpected events, or even in the case of the 2010 election, you can have a couple of weeks without a government being formed. But when you look at what markets like and don't like, it's the absence of a government, not the government that you actually get. And so I think we should all bear that in mind, certainly in the context of UK elections, but then the US elections. And obviously the structure of the US political system is slightly different. And when you go back and look at the US system and the different electoral outcomes in the US, you see the same pattern that, generally speaking, it doesn't really impact markets over the medium term and long term. And if you go back, we looked at the S&P 500 going back to 1928, you can see that it tends to generate returns in line with its long-term average for all years. That's, in election years, it tends to generate returns in line with its long-term average. That's about 7.5%. But election years tend to be more positive, around 78%, 75% of the time.
Okay.
So, sorry, go on.
Yeah, I was just going to say, is there any difference if, you're probably going to get to this point, but I'm going to sort of jump in and preempt it. Is there a difference when you get the result? Because you say markets don't like uncertainty. So that would follow then, do markets like it when whoever the party is, and again, it's not a political judgment, whoever the party is in power has a really strong majority? Is that a good thing or a bad thing?
Yeah, well, this is one for the political scientists, but the observation that I would say, based on the data going back to 1928, is that the markets tend to get a little bit more uncertain when there's a complete alignment of power across Congress into the White House. So you have the same party running Congress in the House and the Senate as you do occupying the White House. Now, why might that be? And this is now where you need the political scientists to come on the show. Possibly because that's the environment where you could potentially, if you wanted to, very quickly enact sweeping change in a particular policy area. And that would potentially be why. But again, all these effects, we are very much at the margin here. We're not, there's nothing that would stand out as statistically significant.
Okay. So we're saying then short term, even though markets, elections are not a surprise, generally speaking. You might get the odd surprise one in the UK, but generally speaking, especially in the US, they're not a surprise unless you have an unfortunate incident where a president is assassinated. We know when they're coming. They're very highly, they're very well signposted. Might get a little bit of short-term volatility, but medium to long term, it doesn't make a difference who is in power. You'll get on our average returns, and some years will be better than others. Depends a little bit where we are in the business cycle. But ultimately, it doesn't really matter who wins the election.
I think that's true. I think there's, in the medium term, you may see impact on particular sectors depending on the policy mix, whoever wins the election. Of course, I'm not suggesting that governments don't have any power to influence the real economy, but that power is generally manifests itself over very long time periods, and it's more about the fiscal backdrop, the ease of doing business, the ability for corporations to create earnings growth. All these, policy, it can influence all of those things, but that's a journey that goes on over a whole cycle, maybe 2 electoral cycles. It doesn't happen overnight.
Yeah. Okay. So we've talked historically what happens. What's driving the current cycle we're in?
Well, this is interesting. I think that's, the cycle today is one that any incoming government, whichever side of the Atlantic or wherever they are in the world, probably needs to be aware of, because when you're thinking about policy and policy mix, so policy mix is the interaction between obviously government directed policy, which is generally fiscal policy, and then the independent policy from the central banks, so interest rates. This particular cycle is unusual, and I think it's unusual. It's unusual for me, and I've been in this industry now for a couple of decades.
Yeah,
and I think it's unusual for many of my colleagues who have not had to work through an economic expansion which is being driven effectively by real incomes. So the kind of expansions that we've lived through recently in our professional careers have been expansions driven by monetary policy.
Yeah.
And consumer confidence is key here, right? Because it comes down to the nature of this cycle, which happens to coincide with an election year. And the cycle we're seeing today is very different. The dynamics seem a bit unusual, but they're not actually that unusual if you go back through economic history. It's an income-led expansion, as I said, and you've got, people like even the Federal Reserve. Maybe I'm doing them a slight disservice here, but you've got people like Neil Kashkari writing essays saying that interest rates have gone up a lot and monetary policy is very tight, but I'm not sure how tight it actually is because the economy keeps growing. Yeah. So there's a lot of people out there, even in policy circles, that are scratching their head, finding this very unusual, finding this a little bit confusing. As I said, it's not a monetary-driven expansion, and it's not even a fiscally driven expansion. So it's not tax. Even though after the pandemic we saw a big surge in fiscal fiscal expansion and tax breaks and tax benefits, right now it's real incomes that are driving it. So it's all about the consumer. Right.
I was going to ask you, sorry to interrupt. I was going to ask you, how much did or did not COVID and government intervention during that period disrupt markets and disrupt the business cycle? Or did it not really that as much perhaps as we thought it would do at the time?
Yeah, I mean, you had this huge whipsaw. You had, we call it lockdown, but I think a better description, which I think is that Adam Tooze actually is coined, which is shutdown. Because we turned off the world economy and then we turned it back on again. If you step back and look at the overall trend, we almost returned to the growth trend that existed pre-pandemic. We had a huge whipsaw in between. And obviously we shot adrenaline back into the world economy in the form of free money and then massive fiscal intervention. But if you look at where we are today, so that explains a lot of the largesse and the supply side problems that we had in 2020 into 2021, and then of course we had some geopolitical shocks in 2022. But if you look at where we are today, where you've got liquidity being drained from the system effectively, and private sector credit creation, so banks and businesses aren't really creating credit, but the economy is still expanding, and the reason is real incomes. So you have to go back and look at consumer confidence in some detail, right? So if let's say you're in America, which is probably the easiest example here, because the American economy has been incredibly resilient, it continues to grow.
Yeah.
whilst the Fed drains liquidity. And despite, obviously Bidenomics and the CHIPS Act, that was huge a couple of years ago. But if you actually look today, fiscal policy is in almost recessionary type levels, right? It's relatively benign. So you go back and look at an American consumer who has seen their house price in many regions double in the last 5 years. And you've seen the 401k, so their invested assets, go up by anywhere between 0.5% and 100% in the last 5 years. So, right now you've got no incentive in the US to save in that because your confidence and your real incomes are rising, and your confidence is high. So it's a very unusual cycle, and that's not going to change. I would say anytime soon. I've got a theory about how it could all come to an end and change, but right now that's not on the cards.
Okay. But I mean, we've very neatly dovetailed into your third point, which is about consumer confidence then. And obviously it's highly subjective. It's not, it's about, I feel better. I feel like, the economy is going to continue growing. I feel like I can afford to go out and do some nice things and go on holiday. And I feel like my job is secure. But that's not across. I mean, we had recently a couple of consumer confidence reports out or indices out. It's not across the board, is it? I mean, US, I think they've had a very strong, not very strong, but more positive consumer confidence. But it's not the same everywhere there, is it? I mean, there are some pockets of a little bit more pessimistic, perhaps, less confident.
Yes, there are. And I think, so we're very focused, obviously, on the consumer and real incomes. But the point that I also glossed over, which we must come back to in another podcast, is about fiscal policy. So the experiment I mentioned with Bidenomics and CHIPS Act, which has now all faded away, but has proven, I think, in certain policy circles that for the first time in many decades, state-directed industrial and fiscal policy is back on the cards. So we have to come back and talk about this.
No. I stopped you because I said you can't have 4 things this week. But we'll definitely, unless anything major happens in the next 7 days, we're going to be talking about that on the next episode. Definitely.
I think we should. So for right now, it's the consumer, but you're right. Consumers' confidence is waning in some areas. So, there's sort of signs that the cycle is slowing. And that's why I think some of this state-directed, particularly in an election year, some of this state-directed policy may come back on the cards again. Anyway, yes, you're right. Consumer confidence is mixed, but if you look at it in the UK, that GfK confidence index, consumer confidence index, that's up. It's still at lower levels than what it was, say, in 2015, but it's back up from its doldrums a year and a half ago. In the US, it's similar pattern, but obviously at a higher level. So you've got a mixed bag out there. But if you step back and look at the chart, and you see that you've improved massively over the last year and a half. And I think it's real asset values, real incomes that have driven that. I think, yes, inflation has this cumulative effect because as things get more expensive, even if the rate of inflation slows, stuff just doesn't get cheap again. Just the rate in which it's getting more expensive has slowed. So I think this inflation has a cumulative effect, and we know that has a negative effect on consumers' confidence. But I think it's been massively outweighed by the real income and asset price effect, which is just astonishing. I think that's been just a huge dynamo for the consumer.
So it sounds like a two-way process. So consumers are more confident because, especially like in America, they've got the 401ks. They can see that going up in value, so they're feeling better. So then they go out and spend a bit more money. That supports, manufacturing in that given country, because people are buying stuff. So that supports earnings, and that then goes back in and supports consumer confidence again. So it's a kind of virtuous circle, isn't it, essentially?
Exactly, and that's an unusual cycle for many people who have only recently joined this industry or been in this industry, because we're so used to monetary expansions, right? So in the run up to the global financial crisis, obviously you had huge amounts of money sloshing around the economy, huge amounts of private sector credit creation out there. So interest rates that obviously affect the short end of the curve, so the near end of the curve, when they went up, they were remarkably effective in slowing that cycle and intervening in that cycle, because it brought a halt immediately to that party. But because, like you said, this cycle is basically someone's earnings are ultimately spent and then become someone else's earnings, and then you get this multiplier effect that is actually, in terms of economic history, well understood, but it's different. It's different this time. So
I was going to say, how much is I want to come to in a moment to understand a little bit how these index numbers are arrived at. But before we get to that, how much is a positive number on a consumer index an indicator of a predictive or lagging? Is it very backward looking? I'm kind of guessing it is.
Yes. So it is. Now, the interesting thing about consumer confidence surveys, well, there's a more prosaic question about surveys right now, where in this age, where there are very few people that actually respond to surveys anymore, whether they be political surveys, consumer confidence surveys, and the types of respondents, I would choose my words extremely carefully, are perhaps not like a good representative sample of the overall economy, or a political cohort in the case of a political survey. So
are they a bit self-selecting, essentially? The people that choose to do it are a particular type of person.
Look, this isn't this isn't something that I've uniquely discovered and acknowledged. This has been a widely reported phenomenon for many years now, and the polling agencies, companies, they adjust for this, okay, and they try very hard to screen this out. But it's just what I think. What I'm trying to say is it's more difficult than it ever has been to get confidence in some of these surveys. And to your point, well, they are backward looking. So the results, first of all, the surveys are generally conducted monthly. Results are released extremely quickly. In fact, they're often released way before other economic data, right? Quite exciting stuff. But it tends to be quite lagging because of the nature of how consumer attitudes change. So how people feel about their position in the economy tends to move quite slowly. So yes, if you look at it on the basis of their release monthly, where you can say that's a coincident indicator, but if you actually look at how consumers respond and how attitudes change, it's quite lagging in that sense.
Okay, I guess what's interesting is, and particularly because I was looking at the US number, it's showing a positive trend, isn't it? Because I think am I right in saying that the latest US figure was, I think it was the first sort of increase in confidence in something like 3 months, and they've also revised up April's figure, so it shows a positive trend.
Yeah, absolutely,
going to be good for the economy.
You are quite right. It's all about the trend here, and in this cycle, as I just described, that is being driven by, I think, real incomes and asset prices. Then consumer confidence is key. So it comes back to if you're a middle class American, you feel remarkably secure in your job right now. The labor market in the US is secularly tight. You've experienced a nice wave of disinflation, and at the same time, your incomes have gone up. So real incomes have gone up, and your asset prices, as I said, your house is probably worth 100% more than what it was 5 years ago. So you couldn't possibly find a more rosy picture for the US consumer, which is you're quite right, which is great for the economy. Should we talk about how these surveys
because
are constructed?
I was looking at the Japanese one, which is one of the ones that's gone down, and I saw that they had a sort of a pool of something like 400 people that they talked to, which seems remarkably unrepresentative of an economy.
Well, yeah, in an economy as big as Japan, they do vary a lot by region. I mean, typically, if you look at like the Conference Board indicator in the US, which is a very well established, well-known index. They look at, I think, about 5,000 households.
Okay.
And they basically say, I want you to appraise your current business and employment conditions and how you expect the future to unfold. And they aggregate all of that into an index. And then that index obviously has 100 as a baseline, and then values over 100 represent optimism, and then values below 100 represent pessimism. And in America, from memory, the survey consists of 5 questions. So you get 2 on current conditions, which is like 40% of the weight, and then 3 on your future expectations, which is 60% of the weight. So they are kind of quite forward-leaning by construction. And you just have to say you're positive, you're negative, or you're neutral. So, what we should be aware of is shock events. So it's about the trend. You were spot on in terms of how you interpret these things. Less about the level, more about the direction of travel. But you can get shock events really disrupt them. So if you looked at, like in this country, if you looked at Brexit and its impact, it caused quite a big temporary divergence between consumer confidence and actual retail sales data.
Right.
So you saw people getting very pessimistic, but they were still shopping.
Yeah. Okay. So there isn't so generally speaking, is it fairly closely correlated then? If people are confident, they're spending money, and unless you get these odd idiosyncratic events or major sort of political events that upset people temporarily, otherwise, generally speaking, it's a fairly good indicator. It's a snapshot, essentially, isn't it? You're taking the temperature of how people are thinking about their future and how likely they are to go and spend some money.
Yeah, follow the trend and look at the big picture direction of travel. And I think it's less about the monthly mark where you end up. It's more about the trend and the inflection points that's interesting. And right now, the American consumer is still in a very buoyant place. And in fact, we've got to look at this relative to, because memories are short, even, a year and a half ago. I think many consumers now have shrugged off. I won't say shrugged off. They have assimilated the effects of high rates. And in the case of the US, that's probably the most extreme example, again, because people have termed out their debt. They've got 30-year mortgages. So they've been insulated from interest rates. Inflation obviously has had a big effect. But if you survey, it's interesting, like consumer confidence survey is one thing, but then if you look at more generalized surveys on how people feel about the economy, that's quite interesting, because you get a very different picture there. You get people much more negative, particularly in America, than they should be, because economic conditions in America are excellent by global comparison. And that's not widely recognized. So this goes back to my point about how surveys are constructed, the samples. It's exceedingly difficult, I think, to get a finger on the pulse now, but doesn't mean we shouldn't look at them. They are good indicators of the overall trend.
Because ultimately, I mean, we've talked before, but if companies are going to do well, they need to sell stuff, and people will buy stuff if they feel comfortable and confident about their future.
Exactly. That's exactly it.
In simple terms. So essentially then we're saying we're where we are in the cycle now, obviously overlaying that over where we are in the electoral cycle, we're still in expansion phase. Let me get my words out. Elections can sort of unsettle markets if they're not sure what's happening, or if we have a position where there isn't a clear result. And there can certainly be some short-term volatility. But what the research tells us, and obviously it can always be different in the future, but what the research tells us, what history tells us, is it doesn't really matter who's in power, because ultimately you'll get kind of average returns. And what impacts market is the economic cycle, not who's in power in number 10 or the White House, or whatever it may be.
That's exactly it, Sarah. That's exactly it.
And consumer confidence is high, and what's driving that at the moment is real income gains. It's not being driven. So the current cycle is not being driven by credit; it's being driven by people actually spending money that they have, not sticking things on a credit card, essentially. Which is, I guess, is a positive thing.
It is. And the things that we should look at, and we'll come back to this, as I said, next week, is now how it's all about the consumer today, but the strategic outlook. I think we should look at, well, what's going to drive the next stage in the economic cycle beyond this one. And I've got some ideas about that.
Yeah, of which chips and the Inflation Reduction Act are just a couple of recent examples.
Yeah, I think let's go right into the heart of the topic, which is about how the globalization, the Washington Consensus, all of these things that I grew up with are now being questioned in a way that's not controversial, in a way that is now saying that the world has changed and perhaps we need to revisit targeted industrial and fiscal policy, and nationalism can work in a collection of nations that all still cooperate together. So it's a difficult needle to thread, but let's try and do that next time.
We'll see if we can do that in around 30 minutes next week. I'm sure we'll manage it. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you very much, David, for joining me today. And thank you, everyone, for listening and for your feedback. If you don't already, please subscribe to Need to Know via any of the usual platforms. And you'll also find previous episodes like last week's, where I spoke with Kitty O'Shea, and we looked at the 3 things that you need to know if you're thinking about investing in prime London property, or even super prime London property. That's all for now. We'll be back next week with more Need to Know, where we're going to be looking at, barring major events, this sort of theme of sort of industrial policy. Until then, bye for now.